How's it, guys? Welcome back to another video. In today's video, I am going to detail the exact step that I use to find setup and take trades. I am going to show you guys step by step what I do from the moment I open my trading view to look for setup and how I get my entries. So if you enjoy these kinds of video, please hit that subscribe button, like, comment, share this video and channel with your friends and family. Now let's get to the video. Okay, guys, what I'm going to do is I'm going to show you step by step on how I take trade entries all the way from the daily time frame for buyers all the way to the 1 minute time frame for entry. So I'm going to show you the exact step what I do on each and every time frame. So let's start with the daily time frame. What I do on a daily time frame. The daily time frame is good for daily buyers. What do I mean by daily buyers? Here I just assume or look at the market and see where the market is likely to go, whether the market is likely to go bearish or is likely to go bullish. So when you look to the left, you realize that the market has been bullish. Why is it bullish? Because the market is making a series of higher highs and higher lows. So when the market is making a series of higher highs and higher lows, you can assume that the market is bullish, right? So when you get a state where the market made this high, now it fails to make a higher high. That means it fails to displace above this high. In technical terms, the market did make a higher high because this high is higher than the previous one, but because it failed to displace above this high, meaning that the market failed to close above this high, we can say this is a liquidity run. This was a liquidity sweep, not a market structure shift. So now this is our first indication that the market is going to go down. But for us to confirm that the market is going to go down, we need to see the market closing below this low. Why is this not enough? Because when you have a situation like this, you have a fair value here, the market can simply come here and fail to make a higher high because it wants to mitigate the fair value before making a serious higher high with a displacement. So the market can come and tap into the 50% of this fair value and make a higher high. So this is our first indication that the market might go down, but it might go down from here to the only the 50% to go and make a higher high. So when the market comes into the fair value and taps the fair value gap here and still fails to make a higher high here, because this high is lower than this high. So this is our second indication that the market is truly failing to go. It's truly facing to go up by failing to make a higher high. So the market make a high which is lower than the previous high. And when it does that, the market comes and closes below this low here. The intermediary low that it created, it closed below it. Now, this is our third indication that the market is going to go down to this low. The first indication, the market failed to make a higher high with a displacement. The second confirmation is the market failed to make a higher high. This is when the market fails to make a higher high. Here, the market failed to displace above this high. Here, the market failed to make a higher high. And now, after making this lower high, the market made a lower low by breaking this structure to the downside. So now this is our third confirmation. Now, when we have this and we have the market closing below this fair value gap here, we can say now this fair value gap turns into a inversion fair value gap. So now we're going to use this inversion fair value gap to take trade entries to the downside. So now we are looking to sell the market. So that's our objective on the daily time frame met. Now let's go to the 1 hour time frame and look for structure and our point of entries. On the 1 hour time frame, you can see structure very clearly in that you can see that this is our range. This is our daily high, which the market failed to take, and this is our daily low, which we think the market is going to take. So we have our range from this high to this low. So now inside this range, we have a clear market structure, which is bearish. Why is it bearish? Because now we came into the 50% of this is the 50% of the fair value gap on the daily time frame. Now, when we close below this fair value gap on the daily time frame and we close it on the 1 hour time frame, now we can expect the market to go down. And where does it go down? It goes down into the 50% of this inversion fair value gap. So now this becomes an inversion fair value gap. So by breaking structure to the downside here and making a lower low, this becomes our liquidity inducement, meaning our liquidity sweep. So the market is going to take liquidity from the upside before going for this external liquidity. So this will be your internal liquidity, this will be your external liquidity. So the market is trying to take out the internal liquidity before it takes out the external liquidity. After taking this external liquidity, the market is sharp to close below this low. So we have the market closing below this low, making a lower low again. But if you see clearly, the market is failing to, again, does not close or does not even take out the low on the daily time frame. But we have this clear displacement on the 1 hour time frame, telling us that the momentum is now bearish. So now what we can do is we can do this. We can take out our fib from here to this low and look for our premium and market and discounted market. So this is our premium market, and we look for our fair value gap in our premium market. So the clear fair value gap that we can see that is in a deep premium market is this one. We cannot use this one because it also fall inside the discounted market. So the only one that is fully in the premium market is this one. So from here we expect the market to come into the fair value gap on the 1 hour time frame before going down. So which is, now we have the market making this high, then the market is consolidating. Take some days consolidating. These days was consolidating, this consolidating, and now we have a clear break of structure to the downside here. Clear break of structure to the downside, further confirming that the market is going to go down, but it cannot go down without taking this buy side liquidity. It cannot go down without taking this buy side liquidity, which it happens to happen here. We have the market taking out this buy side liquidity but failing to go into this fair value gap on the 1 hour time frame. So let me name this fair value gap, failing to go into this fair value gap on the daily time frame. So we still expect the market to come into this fair value gap. So now we have the market making another low by breaking this low. So we have a lower low by breaking this low. But when they were making this low, the market inevitably made equal lows. So these are relative equal lows or equal lows because they are almost on the same price. So now this is a huge draw on liquidity, which happened to be just before the daily low, which we expect the daily low to be taken. So the market comes and make this high, make this low, then displaces above this high again. So when it displaces above this high and goes into the fair value gap here, now we expect the market to come and attack this relative equal lows and this low on the daily time frame. So now what do we look for? We look for our point of entries on the 1 hour time frame. So you can see the first place that we can look at is here on the smaller time frame. But on the 1 hour time frame, our point of interest is going to be this fair value gap here. Why is this fair value gap here? Because this fair value gap here is in a discounted market. So let's take out our fib from here, from this high to this low. It's in a discounted market, and we have a market structure shift by the market breaking this low here. The low got broken here with this candle with a displacement. I told you that displacement comes in two steps. The, the candle that displaces and further candle that goes to the same direction as the displacement candle. So now we expect the market to come into this fair value gap here before selling. Now we have our pound of interest on the 1 hour time frame. Now let's go to the 15-minute time frame and look for our liquidity sweep. Okay, here we are on the 15 minutes time frame. We have this liquidity, we have this market structure shift on the 1 hour time frame with this candle here. Now if you look at our structure here, we find that we have this high here, which ironically aligns with our fair value gap, which becomes our internal liquidity. It's our internal liquidity because it's inside the range of this high and this low. So this becomes our internal liquidity. This is our external liquidity, and this is our external liquidity. So this becomes our internal liquidity. So now I have my internal liquidity. Now I'm going to plot out my trading session, which is New York AM. So I'm going to look for 8:30. And for bonus, I'm going to look for something which I've never talked about. I'm going to look for New York midnight open candle, which is this one here. This candle here, this is our New York midnight open. Why am I looking for this candle? This candle is useful to us in the sense that if we are expecting the market to sell, like we are on the daily time frame, we expect the market to be bearish. We want to sell when the market is above this New York open candle. So this will count as our manipulation. So after this manipulation, we expect the market to go down. So this will count as our manipulation, as I've said. So we want the market to go above this midnight New York midnight open, then our manipulation occurs. Then that's when you are going to sell. But we do not sell on the 15-minute time frame because the 15-minute time frame is there for our liquidity. So now we have our buy side liquidity in the form of our internal liquidity, and now we are going to look for our sell side liquidity from here. This is our sell side liquidity, our immediate sell side liquidity, and this is our relative equal lows on the 1 hour time frame, and this is our daily low. This is our daily low. So this is where we expect the market to end up being at, because we expect the market on the daily time frame to take out this low. So now that we have our 8:30 open, we have our midnight open candle, we have our sell side liquidity, we have our buy side liquidity. Let me name this our buy side liquidity and sell side liquidity. our buy side liquidity and our sell side liquidity, and further sell side liquidity to the downside. So this is not our sell side liquidity, this is our New York midnight open. So this is our sell side liquidity. So now we can go to the 1 minute time frame and look for our entries. Okay, now we are at the 1 minute time frame. What the 1 minute time frame, we are looking for a market structure shift to the downside, right? So we have the market going above this internal buy side liquidity here, going above this internal buy side liquidity here, and making this high. And after making this high, we see the market going above this high again, so taking out liquidity again. So from this high, we see the market dropping a bit, then we see the market making this high, which is again failing to make a high. So this is our first indication that we are going to see a market structure shift. So that when the market fails to make a high, so we see from here, we see the market displacing to the downside by breaking structure to the downside. So we have a break of structure here, and we have our market structure shift here. We have our market structure shift here. So this is our break of structure, and this is our market structure shift. So when we have this two concepts together, we are going to look for our third concept, which is our discount and premium. So this is our discount and premium. Now we are going to look for our point of entries in a premium market, because now we're looking to sell. So we are going to have this fair value gap here. We have this fair value gap here, which we expect the market to come and mitigate the 50% of it before going down. So when the market is coming to make this high, if you are a person who trade the open of the fair value gap, you can take your entry here and keep your stop loss above this high, but your entry your risk is going to be too much. So I like trading the 50% range, because I want to maximize the profit that I can get from the market, because I like to take partials, right? So what I'm going to do is I'm going to take a short position here at the 50% here, and I'm going to keep my stop loss above this high, just above this high, and my first target is going to be my immediate sell side liquidity. So this 15-minute sell side liquidity, that's where I'm going to take my first partial. So I'm going to take my first partial when the market comes here, and I'm going to move my stop loss into profit. So I'm going to move my stop loss just above this high here. So now my trade is running risk free, and I already took money out from the market. So now I can relax. I have no trading psychology that is going to mess with my understanding of what the market is trying to do. So now I can trade clearly. So now the next target is going to be what? The relative equal lows on the 1 hour time frame. So this is my first target, because this is the sell side liquidity. This is the New York midnight open. This is the sell side liquidity. So this is the first target. So when the market is here, I take partials and I put my stop loss above here. So when did it get here? It got here from this candle here. So when the market is here, my stop loss is here, and I already took profit. I already took partials. So another target is going to be one, the equal lows or relative equal lows on the 1 hour time frame, and I take further partials, and I'm going to move my stop loss just above this high again. Then when the market is here, I'm going to take partials again and move my stop loss above this high. So what I do is I do not close my trades. I let the market stop me out in profit. So I keep on trailing my stop loss up until the market closes my trades. So when the market is down here, I'm just gonna keep on trailing profits and taking partials if needed be, or and moving my stop loss into further and further into profit until I get the market to stop me down. So when the market is here, my stop loss is here. When the market is here, my stop loss is here now. So I'm gonna keep on trailing until the market comes and take out my stop loss. That's when I'm out of the trade. I do not automatically, I don't take myself out of a trade. I let the market dictate to me when I should get out of a trade, right? So that's what I do when I first look for my setup and my entries. I go to the one daily time frame for my buyers. I go to the 1 hour time frame for structure and my point of interest. I look for liquidity on the 15 minutes, and I look for entries on the 1 minute, and I take entries and I manage my trades up until the rest of the, I can hold the trade for a week, because as long as the market does not take me out in profit, I do not exit my position. So if NFP comes, it finds me in the profit, I'm not closing my profit because it's NFP. I'm just going to keep on trading the stop loss until the market takes me out, right? So I hope you enjoyed this video. If you have enjoyed, please continue subscribing, liking, and commenting under this video. Till we meet again on another video. Peace out.